Hey everyone, welcome back to Meet Kevin Report number 104. Today we have the PPI Producer Price Inflation Report, and we're going to cover a lot of what's going on with the Federal Reserve today as well, given the Fed is speaking. I do want to hit this survey that CNBC is reviewing, so let's go ahead and jump right into that first. So let's actually start there. Here we go. There we go. Mhm. Yeah. Oh, is it not playing any sound? Are you serious? Oh, I'm sorry. My fault. Okay, let me solve that. That's my fault. That means I screwed it up. Okay, so I'll just quickly explain that. Sorry, that was basically just a lot of silence for you. Basically, what they just talked about in the CNBC survey, which was sort of just a lead into something I wanted to talk about in another survey anyway, was this transition in consumers spending less on consumer staples. And this is something that we've somewhat had an expectation that would happen along with some discretionaries beyond what we already know. We already know that people are spending overall less on clothing or PCs or other durable goods. Somebody asked me, for example, Whirlpool yesterday. What about Whirlpool? That was such a big play during the pandemic because everybody's going out and buying a new washing machine, right? And a lot of that has really transitioned away now. It seems much like many people, when it comes to spending today, are really being a little bit more choosy with their spending. Ironically, though, still spending, and I find that very interesting because if we go to the let's go to St. Louis Fred personal savings. Okay, if we go to the personal savings rate, let's see how the latest update is on this. It's been a minute since we've looked at that one, so we'll share the screen here with the personal savings rate. Here's the personal savings rate chart. And what we found is you've had a tick up from the lows, but look at this. You actually just in the April survey had a little bit of a tick back down again. So there's certainly a pressure on the amount of excess money that individuals have compared to what we've been used to in dare I say used to, right? But look at the 2020, February 2020 to really well, you could probably go with February of 2022 era. Between these 2 years, you had 2 years of more money coming in than people were generally used to. And it's a remarkable transition going from this sort of excess personal savings to actually this deficit over here that we had in June of 2022. This is really when folks were convinced there was going to be a recession, to now sitting about 4.5 to 4.1, a little bit of a decline here on the margin, though the number tends to be pretty volatile and not straight in direction. But anyway, the CNBC survey somewhat expected, so maybe not a horrible surprise anyway, but something I wanted to share. We'll also review a Bank of America fund manager survey in just a moment. That'll be quite interesting to see how fund managers are positioning or are not positioning. So that'll be neat. Then we've got to cover, let's see here, PPI expectations as well. Let's go ahead and jump into PPI audio, or PPI audio, PPI. Now y'all got me confused. That's all right. It was my fault. Let's go to the 5-year break even and then what PPI expectations are. PPI will be out in an hour from right now, and we're looking at a PPI final demand expectation. That's your month over month read of negative zero point 0.1. When you extract food and energy, since you did have that food and energy really disinflation or near deflation, you're looking at 0.2%. And if you take out trade as well, still sitting at 0.2%. All of those relatively consistent with 2% inflation. So not expecting any kind of major shock today from the producer price index. So we'll see what we get in just about an hour. Then as far as the year over year numbers, you're looking at a final demand read on producer price inflation of just 1.5%, as well as a core year over year at a 2.9, with core year over year without trade sitting at 3.1. So really, from a producer price point of view, we should actually be in a position where producer prices actually help the inflation story. Although I'm beginning to doubt how many people actually think inflation is still an issue. I think more the fear now is maybe it's not inflation that's the problem. Is that earnings recession actually going to come around? So we'll see. That'll be the big concern. A lot of discussion now, obviously, on okay, well, is the Federal Reserve actually going to pause, and is that going to be the best thing for the Federal Reserve to do? In fact, there was a piece this morning from an economist over in Bloomberg discussing that a pause would actually be very risky for the Fed, that even though there are long and variable lags for monetary policy, the danger of pausing is risking breaking those inflation expectations. And I found that very interesting that somebody would complain about inflation expectations, predominantly because we have had such anchored inflation expectations. In fact, if we jump on over to the 5-year break even, and try to understand what the bond market is screaming at us when it comes to inflation, we can actually see that the 5-year break even is still sitting at about 2.14%. So this has been pretty consistent with where we've been just the last couple months. If anything, it's on the low end of the last couple months. And really, no bond signals that inflation is really running away. And I want to say, of the fund manager surveys that I've been reading, only about 2% of fund managers actually expect inflation to get worse. The question is not that it'll get worse, though, it is how long will it take to get inflation down? And I think that's where there's a bit of a mismatch in how quickly individuals believe the Fed actually has to reduce inflation. And I think that's something to consider about when you're looking for your own portfolio, is how long does it actually take for you to believe that the Federal Reserve can be patient again, and that could be good for equities. And that becomes a very important question, because if you think that inflation has to go to 2% before the stock market's going to go up, you might end up missing a lot of the stock market's movements. Now, let me do a quick test again. I believe this should work when I press audio here. Tell me if you can hear this.
Starting to get a handle on inflation. What do you think, Liz?
I think probably the era of unanimous votes on the FOMC could be over, and we will start to see some dissents, and we'll start to see.
Okay, I'll just test to see if y'all can see that audio. So this is a very fascinating idea about this. Okay, maybe the Federal Reserves will start. Thank you. We'll start having some dissents. Also, I find it interesting. I wonder if SoFi pays to be on CNBC, because it feels like they're on CNBC like every single day, and I think it's quite frankly just marketing. Like, oh, let's market our stock to the retail audience. I mean, you can't really blame that idea, right? If you get more liquidity for the stock, or you meme it or whatever, because it's done very well, and then it reiterates, "Oh yeah, that's right. I wanted to buy SoFi." It's kind of a it's not a bad strategy necessarily. So, but anyway, this idea about, oh, now all of a sudden we're not going to get unanimity anymore at the Federal Reserve. I don't know about that. I think the Federal Reserve is really keen on sending signals to the market. And I think a lot of their debating happens behind closed doors. They arrive at consensus and then you give up. Basically, you just everybody throws in the towel and agrees with the chair. Now, I don't know that that's necessarily a good thing. In fact, today we're going to be getting a summary of economic projections, and that actually could be very fascinating to what the market might react with. In fact, if you end up getting a summary of economic projections that is hawkish, while at the same time you get a pause, you could actually end up getting a negative. You could end up having a negative day with the Fed today, and I think that's something to consider going into this Fed meeting, is a summary of economic projections. In fact, what we should do is we should look at the last summary of economic projections and just consider for a moment, what might the Federal Reserve do to modify these, and then how could those modifications end up affecting markets. So the last one was from March, and let's see here, FOMC. Okay, I'm going to go ahead and pull that up, and then we'll look at it together. It'll be this summary of economic projections does the new one, or sorry, actually last one was March. The next one is today, and then we don't get another one until September. So you kind of have this skipping of meetings, and the last one from March gave us a terminal rate expectation, and we're going to want to think about how is the Fed going to doink with that terminal rate expectation today, in order to signal to the market that, hey, don't think we're done. So I think that's going to be a pretty critical piece of what they try to signal to us. So give me a moment while I pull that up. In the meantime, I got some Timmies over here from. Why am I having such trouble finding the summary of economic projections today? I'll get to the bottom of it. Anyway, but I do have Timmy's. In case you've never seen Timmy's, it's Tim Hortons. It's like 10 times better than Starbucks, and it kind of makes you wish that you had it in America. But cheers to your morning coffee. All right. Well, while I grab that, let's go ahead and think about not just the implications of the summary of economic projections today and what these changes could look like. But let's also consider for a moment the stock implications. Is it possible that if we end up getting a hotter summary of economic projections today, that some of the more, dare I say, momentum stocks end up getting hit a little harder? We've had some pretty large runs yesterday on, again, momentum names. And there are two ways to look at this. One is that, hey, if everything's good with the Fed, maybe those inexpensive call options on some low volatility, names that used to be momentum stocks that could become momentum stocks again make sense. There's a lot of trading involved in that. Therefore, there's a lot of risk. I mean, you could place, 10 call option bets, and the ones you didn't place bets on end up rallying. So it's kind of unpredictable. Like, I don't think I've ever seen Dave & Buster's actually rally the way it did yesterday before. That was remarkable. It was up like 22%. We were just talking about the fundamentals of Dave & Buster's yesterday morning, and it was a few hours into the day. All of a sudden, Dave & Buster's just takes off. It's absolutely incredible. All right, I've got the summary of economic projections. So let's do a little bit of a preview on the SEP. There'll be a lot of talk on the SEP today, so buckle up for that. And I suppose I'll make a quick little timestamp note as well that we'll talk about the SEP here. So let's see here. Ooh, Timmy's compared to Duncan. That's a good comparison. I mean, I think Timmy's edges it out. Duncan's pretty good, though, in my opinion. But as much as I go to Starbucks because it's readily available, it's still kind of at the bottom of the list. All right. All right, let's do a Fed preview and talk about the Federal Reserve's upcoming summary of economic projections, which is going to be a big deal because it only comes out roughly every other Fed meeting, and this is one of those. And even though we could get a pause today, we might even get talk about a pause for July, which isn't really priced in right now. You're kind of sitting at about 66% chance of a hike again in July. This summary of economic projections could set the tone, and you really want to go into this Fed meeting with the right expectations for risk. And that is, in my opinion, potential downside risk. We've had a lot of rally mode. We've had a lot of good news leading to rallying, good CPI. We've got PPI. But now we've got to look at the SEP, and there could potentially be some concerns coming from it. So let's pull up the SEP. While I pull up the SEP, thank you so much, Corey, for shouting out. Your daily content helped me land a sales and trading analyst position for Wells Fargo as a sophomore here since March of 2020. Wow, that's really impressive. Thank you so much, and congratulations to you. And remember, hey, you can always join those courses linked down below if anybody else is interested in even more deep dive perspectives. But let's go ahead and jump into this summary of economic projections. And let's see what we have here. Now, this is the last summary of economic projections that we got. This is from March 2022. And what I'd like to do is mark up what are likely going to be the biggest numbers. And so the first one we're going to start with, by far, that I think everybody cares about the most from the Fed, is this item right here, that Fed funds rate. Where does the Federal Reserve think the Fed funds rate will be for 2023, 4, and 5? I actually think the Fed has this potential of doing some massive signaling right here for the end of 2023. And the reason for that is simple. At the end of 2023, the bond market still believes there's a chance the Federal Reserve is going to cut. That is, if they raise in July, the bond market is projecting the Fed is going to drop back to 5% in December. In fact, when you look at world interest rate probabilities, you see an increase going into July and a decline going into December. The Fed could absolutely destroy that by simply revising this number higher. My guess is if the Fed wanted to really price in the potential of another hike, you have to consider the following. Right now, Fed rate policy sits somewhere between 5 to 5.25. It's sort of a market determined floating rate. And when you consider a rate increase, you would need this number to rise slightly above 5.25. My guess is that this number, and even though it's just sort of an average or a median, it's supposed to be a middle indicator of what the Fed is thinking. I kind of think they somewhat collude on these numbers a little bit. No guarantees. Jerome Powell says they don't, but then again, I don't necessarily believe that. But that's okay. It's okay to not believe them for a moment. But anyway, so if we consider this, what do we end up having as a Fed potential? Well, I think the Fed ends up saying 5.3 as a reality here. Now, what's neat about that is you're actually 10 basis points above the low end right now. But how many basis points are you actually above if you go to 5.3? Well, you're actually only about 5 basis points above the low end if you go with 5.3, because the low end would be 5.25 on another rate hike. However, it does signal some slight opening to that potential to another rate hike. If this number does not move up to 5.3, the Fed is telling you, yeah, we're probably not going to hike. So you kind of have to see this number go to 5.3. Otherwise, I think everybody's going to call the Fed's bluff. And if the number goes down, it means you're signaling price cuts. Stocks are going to moon even more than they already have. It'd be ridiculous. I think this has to go to 5.3. Now, any number above 5.3, in my opinion, is extremely hawkish. Because if we start going to the neighborhood of 5.5, let's say, so I'll put 5.3 would kind of be like, okay, we kind of anticipated that. But if we end up going with a number like 5.5, I would probably call that a sad face, and 5.4 somewhere in between, right? From like neutral to slightly negative. But I think this number matters the most followed by probably their projection for next year, although they've been wrong about their projections and too low about their projections consistently and historically. So I don't know that the forward projection matters too terribly much. I would probably consider maybe leaving at 4.3 the end of next year number and staying something with a slight elevated tune to the number over here on the 2023 figure. So I think this number matters a lot. I actually believe the Federal Reserve is going to signal to us that, hey, we don't have to cause as much unemployment as we previously thought. I believe the Fed's probably going to go with a 4.1 revision right here. So we're going to go from 4.5 to about 4.1, and we might see this this future terminal number come down as well. This might end up being like a 4.3. So I think you'll see a softness in the unemployment rate here. In terms of GDP, you'll probably see a revision up as markets punt GDP or a recession into next year. And I wouldn't be surprised if the others somewhat stay stable, but I wouldn't be shocked to see a pump up over here. I don't think you'll see a pump down. If you see so if I had to prioritize these and I was going to give sort of a ranking as to which to pay attention to, well, we'll label them, but I would certainly start with the Fed funds rate. That's absolutely where I would start. Their inflation projection is going to matter, but in my opinion, not as much. Before I break down, though, the exact ranking, I just want to give you a quick breakdown on the following. This is a change that we're making. What we're actually doing is we're going with a 4-phase of price increasing here because we're getting a lot of emails at staff at Meet Kevin for the courses and people saying, hey, I'm waiting until this date to join or whatever. So we just wanted to be really transparent with what's happening in the courses. So you could see that on screen now, and then I don't have to talk about it that much. But basically, we're having 4 phases of price increases for each course. And then after those 4 phases, which would mean the base prices are going to be about $200 to $300 higher, each of these courses is getting a very large new lecture set of releases, all 3 of these courses right here. And so it'll be a pretty big deal. At least we're pretty excited about it. So anyway, I put it on screen so I can talk about it less long, just out of respect for everybody. It keeps it a little shorter, while at the same time putting that information out there for those who want it. So I think that's a little easier. But let's label this in numbers here. So top priority, I think, is this Fed funds rate. That's number one, without a doubt. Again, if they don't go to 5.3, they're signaling that they're bluffing about potentially raising rates in the future. So I don't think they can do that. The markets have reacted very negatively to a downward revision in GDP before. So it's possible that you could get a neutral response from markets if you get like a 5.3 on the future Fed funds rate, and maybe something like a 0.6, a slight revision up in GDP. That could be good. Markets like this. So I'm going to put a mark over here that markets really seem to care about this. What markets actually surprisingly don't seem to care about that much is actually, I know it sounds crazy, but rates. The interest rate expectations for the Fed have really fallen. And if we look at the world interest rate probability today, and when I say fallen, I mean they've shifted to a point where the market's not pricing in as many cuts anymore. In fact, it's gotten pretty steep. The market's almost already completely priced out rate cuts this year. I'll show this to you in a chart, which is quite remarkable. But what's really the insane part is that you have a Fed that's made it clear they don't want to cut this year. Markets transitioned from, okay, we're pricing in rate cuts to, oh, okay, never mind, we have to wait for rate cuts next year. And the market's gone up. So while the market's gone up, you've actually seen this reduction in interest rate cut expectations. Let's look at this a little more closely. So if I draw an arrow on this world interest rate probability chart, what I want you to see is that right now we're actually sitting here. Let's draw a line in it. Right now we are sitting, cut that out, there we go. We're sitting right about here right now. And you could see that markets are really pricing in this extra hike over here somewhere between July and September now. Now, I think that's actually quite interesting because previously we were not pricing in a peak here in September. Instead, you were pricing in a peak in July. And so you've actually delayed that peak to your September meeting, and your potential for a first cut between November and December, and then your larger cut where you're actually getting below 5% is being priced in for January. All of this is a massive shift from where we were during the banking crisis. Consider for a moment where we were 3 months ago today. And honestly, I think it's a little weird that it's already been 3 months since the banking crisis. I don't know what happened, but time seems to be going very, very quickly this year. And it kind of feels weird. But let me show you. I'll share screen here. So let's see here. Present the other screen. Just takes me a second to pull up the other window. And then I'll have that up for us. There we go. All right. Not that one. Let's go with this one. Here we go. So take a look at this. This is the world interest rate probability chart from March. And look at this. March had a peak priced in for May, and the peak was actually below 5%. You had about a 4.95% peak priced in for May, folks. We're already above that. And look at where the cuts were priced in. The market was pricing in cuts as soon as September, and then multiple cuts. You were looking at somewhere around 1.75 basis points of, or sorry, 170 basis points of cuts, 1.7% of cuts by January. This is insane. I mean, the fact that we went from this crazy amount of cuts to quite literally no cuts this year, a terminal rate now either in July or in a terminal rate in September, and the market's gone basically straight up over that time frame. Folks, it's nuts. And it really actually goes to show you that markets right now don't really care about this terminal interest rate or the higher for longer regime. I think markets are realizing inflation is gone. We're not expecting a Paul Volcker. Sure, things might stay higher for longer, but we're almost okay with that. Look at the NASDAQ. Look at where we sat on March 14th. Right here in the middle of this chart is where we were pricing in 170 basis points of cuts by the end of the year. Now we're pricing in no cuts by the end of the year, and we're pricing in that we still don't have a terminal Fed funds rate. And where's the market? Oh, don't mind us. It's only 20% higher than where it was over here. Look at that. We were at about 300 on the Qs here, and now we're sitting at 363. That's over 20% higher, despite the fact that the market has unpriced all of those Fed rate cuts that were priced in for this year. That's insane. By the way, that website there with the chart is Webull. If you want to join Webull, get yourself 12 free stocks by going to metkevin.com/free. All the affiliates are linked down below. That is a paid promotion. I can also throw up this little paid promotion banner here thanks to using StreamYard. StreamYard's pretty awesome. You can throw up a bunch of banners. Look at that. There's my StreamYard pitch. I have a banner for it. metkevin.com/StreamYard to learn how to do that. Okay, so continuing with this chart here, this summary of economic projections. A lot of people refer to the dot plot, and the dot plot is actually something that you could see here. What I like to do, although it's somewhat difficult to get appropriate because you're taking into account 16 to 18 different people's perspectives. But what I like to do is somewhat predict where I think most of the dots are going to go for this particular meeting. And so what I'm going to do is I'm going to look for the 5.3 number, which is going to actually sit about where those three dots are, 5.3, 5.35 even. But unfortunately, 5.35 will round to 5.34. But anyway, I would expect you're going to see a shift up of the majority of these dots to right here. That would be my guess, is that most of Fed participants, the Fed participants, will price in about maybe that one more rate hike. They can always adjust down. But remember, this is a signaling tool. They are not committing to what is on this chart. It is solely a signaling tool. And if they want to prevent inflation expectations from running away, they probably want to signal either being roughly here with the majority of these dots, or they'll want to bulk up a little bit here to maybe even signal one or two more hikes. Something like this is what I would expect for the dot plot. I do not think we'll see anyone down here. And even though there's the chance that you're going to have somebody super high up here, I wouldn't be surprised if you eliminate this top edge. So I think you'll eliminate the edges and you'll get some concentration amongst that 525 to 54 level. That would be consistent, in my opinion, with really signaling, hey, we're not necessarily done. Now, don't get me wrong. I think the Federal Reserve is going to be done. And that's mostly because of history and weak CPI. So weak inflation, weak wage inflation, those three things. Weak inflation, core inflation coming down, super core plummeting, super core way down. I mean, you're the, under 3% range annualized. It's fantastic. So super core is way down. Wage pressures are evaporating by the month. I mean, it's incredible how wage pressures are falling. And then, of course, you have history that says the Fed should not stop, start, stop, start. So all of those three aspects, those three things we just talked about, you really, really consider them and then pay attention to them, right? Wages, CPI, super core, pretty important. And then obviously, oh, what was the third one I just mentioned? I don't know why it escaped me. But anyway, the three things that we just mentioned: wages, CPI, supercore. It wasn't inflation expectations. We already went through that. I can't remember what. Somebody write in the comments, please, what the third one was. But I just wanted to outline them. I need more coffee, is what it is. But anyway, history, of course. That's so stupid. The historical aspect. Thank you. So history. All of these three things right here are really going to destroy the ability for the Fed to actually raise. So here's what I really want you to take away from this segment. What I want you to take away from this segment is this word that everybody loves on YouTube. And I actually think the Fed is going to pull this off on us. I could be wrong. And it depends what the next CPI is going to do. But you ready for this? I think the Fed's going to pull off a clickbait over here. I think the Fed is going to try to signal clickbait in saying we're going to be more aggressive. So they're going to signal clickbait. But these three things are going to eliminate that possibility of actually happening. And they'll end up staying paused again for July. And what we'll do is we'll just keep kicking the can down the road of these expectations of what the Fed is going to do. That's my thesis, and I'm sticking to it. Unless, of course, the data changes, then we'll flip-flop. But right now, the data does not say that another hike is necessary. My take. Now, we'll see. But again, take a look at those courses on building your wealth link down below. Get lifetime access to them. Remember, we've got 4 phases of price increases. The first price increase is happening on the 16th, which is just in 2 days. So if you want to lock in the best price before we get through 4 phases of price increases before this massive lecture drop coming up, you'll want to join before the 16th. Remember, you could always email us for bundle code or questions at staff@meetkevin.com. We'll be more than happy to take care of you. But otherwise, that gives you my thesis on what's going on with the Fed over here. And we'll see what happens today. But we'll be comparing this to what we actually get from the Federal Reserve today. So we'll see. Okay, with that said, let's jump on over to see if CNBC's got anything of use for us at the moment. And then I'm going to pull up some other reports here. So let's see here. Let's go ahead and do this. Present. Share screen. Tab. Oh, hello.
We'll hope to see you again. We'll see whether anything changes.
Nope, they're going into TV commercial, and there we go. It doesn't look like we're going to listen to more of this.
British Oil giant Shell. Squawk Box will be right back.
Nope. Look at that. Perfect timing. Right into a TV commercial. Fine. We'll have them ready for when we come back. So at the moment, it does look like we have futures trying to trend a little closer to green. I think that I was expecting some more red, quite frankly, before the Fed meeting. And so we'll see if we end up getting that not Nike swoosh, sort of a V shape during the press conference again. It seems to be what we get is when the statement comes out at 11 a.m., you get this initial plummet. And then after about 5 minutes, the market rises. And then about halfway through Jerome Powell's talking, the market falls. And then like 7 out of 10 times, the market actually rises again towards the end of the day. So if you're a trader, today tends to be a pretty great day for volatility trading with the Fed. Obviously, we'll be covering the Fed. Mark your calendar because we're actually already getting, we're getting somewhat close already to the Fed meeting. You're about 6 hours away from the Fed meeting, and you'll have the press statement that'll come out at 11 a.m. Pacific time. And then, of course, you'll have the Fed press release. Well, I'm sorry, their press conference will be 30 minutes after that. We'll be covering that. And it should be pretty exciting, especially since data is coming in pretty good, and it would be nice to see a little bit of glowing from Jerome Powell about how maybe he could actually pull off a soft landing. Mostly saying that because it would be extremely bullish for markets, but I do think they have to strike that balance of a tone. If they're not aggressive enough, they they do risk causing some problems. So we'll find out what happens then. Now, after we take a listen into CNBC for a little bit, we're going to jump into the Bank of America Fund Manager Survey. In about 30 minutes, we'll have PPI coming up. So we'll go through the producer price release, which should be the final reiteration that we need for a Fed pause today. If we got some kind of massive de-anchoring today, it would be a big problem. You end up seeing PPI tend to lead CPI. And this makes intuitive sense if you consider that when you have excess demand, the first place you tend to experience that excess demand is in producer prices, right? You have to ramp up the machinery before you actually have more product on which you can raise prices. And so it is typically common to see a ramp up of PPI first before a ramp up in CPI. That could be a risk factor if, for example, we're in a situation where, hey, all of a sudden PPI unanchors. We could end up getting a Federal Reserve chairperson who says, hey, look, PPI unanchoring this morning is a red flag and could be a leading indicator for CPI unanchoring, and that could unanchor inflation expectations. In other words, you could have a little poopsie doopsies if we got a PPI miss this morning. Nobody's really expecting a PPI miss, although then again, those are the times you really have to pay attention to them because when nobody's expecting it is kind of when you get the problems. So we'll see. Again, that'll be in about 6 hours. We'll cover the Fed live, and I'll be covering that. Even though I'm out here on Canada, vacation with the family. Yesterday, we had a little fire pit. Mr. Raccoony came over. Mr. Raccoony was very nice. You have to be careful if you feed them, though, because then they never go away. And they always come back. But anyway, so let's see here. Yeah, Tesla over 258. What's the next stop? Yeah, well, let's see what happens with the Fed today first, because we closed at 258, which is literally your resistance level. So you've closed there. Quite frankly, the next stop after that, if you get a good positive Fed meeting today and they're talking dirty isn't too tough, next stop is 295. That's insane, but maybe not. So we'll see. Okay, so then we have, let's see, CNBC here. They are. Let's take a listen to them. See what they have for us.
Business stories. The International Energy Agency says global oil demand growth will peak this decade. The IEA's executive director pinned that production on the advancement of electric vehicles, energy efficiency, and other technologies. Although obviously we're going to need to power those electric vehicles. So it's just one step removed. Amazon's considering using new AI processors from chip giant AMD for its web services business. That's according to Reuters. NVDA currently dominates the AI chip sector. Shares of AMD rising on this news. And the PGA Tour says its commissioner, Jay Monahan, is taking a medical leave of absence. Monahan's exact medical condition is unclear. This is kind of troubling. Did you know that?
No, I did not.
But the news comes just a few days after the blockbuster announcement that the PGA Tour would partner with Saudi Arabia-backed Live Golf to create a new business. The two sides had been involved in bitter litigation and expensive litigation before last week's resolution.
All right, now let's get over to Dom Chu. He's got a look at some of the morning's biggest pre-market movers. And what stocks are you eyeing right now, Dom?
All right, so Becky, we'll begin with mega cap tech and media because shares of Alphabet are down just about fractionally right now pre-market, around 100,000 shares of trading volume, about 0.25% downside. The European Union has now charged the company's Google division with anti-competitive practices, specifically for its advertising technology or ad tech business. It's the European Commission, which is the executive arm of the EU, that alleges that Google has abused its market dominance for ad tech since at least 2014. It also hinted that Google might have to break up the business to satisfy competition rules in that jurisdiction. Google has not yet, as I've heard, responded to those charges, so Alphabet shares down about 0.25%. We're also watching shares of Logitech, which are sinking by now over 10% right now, over 100,000 shares of volume. After the close yesterday, the company, the maker of personal computing peripherals, we're talking mice, keyboards, universal remotes, other kind of things. It announces the surprise departure of its CEO, Bracken Darrell, who's pursuing other opportunities. Board member Guy Gecht will be the interim CEO. The stock is getting a lot of negative analyst reaction on the heels of that, including at Citi, where the shares were now downgraded to a neutral from a buy, citing that executive shakeup. So Logitech down 10.5%. And we'll end with financial technology. Shares of PayPal and SoFi are on the move higher, 2.5% for SoFi, PayPal up about 1.25%. Analysts over at BTIG have initiated coverage on those stocks and several others in the business. SoFi and PayPal in particular are amongst the slate getting buy ratings. They like SoFi's strong and diversified revenue streams and rapid deposit growth. For PayPal, they think shares are cheap and provide good risk reward at current levels, Becky. So keep an eye on SoFi. And
SoFi is not diversifying revenues. They're mostly student loan or mostly personal loans right now has been the big surge. And you wonder what happens if that slows down. But SoFi is moving mostly off momentum. So I find it very interesting that you have all of these initiations coming after momentum. But then again, that seems to be what these analysts do. As far as PayPal, I am so stuck on PayPal. PayPal, and I'd like to enlist the commenters, whether in the YouTube video later down below in the comments or the live chat. Either way, PayPal is such a difficult one because you look at the risk reward, and if you simply look at it from a TA point of view, you get the following. You get a chart that basically says, bro, it's at the bottom. Like, we've essentially rejected this 1, 2, 3 times. Maybe you could trend slightly lower, but look at how slow this bottom trend is really moving. I teach, by the way, basic technical analysis that, or I should say, highly effective, but simple, the most effective fundamental analysis in the Stocks Insight course link down below. But anyway, you have such a slow downtrend in terms of a slope of just 15% or less, depending on how you want to draw it, 15 to 10%. Your downside feels limited at PayPal. The problem is this going to switch from a growth stock into a value play, and then is it going to get re-underwritten? And that would make the chart completely invaluable. It just wouldn't matter, the technical analysis, because if now people treat it as, okay, well, it's just going to end up being a dividend play. Well, first of all, the company has to offer dividends, but second of all, the company would then be admitting to growth not happening anymore. There's a lot of competition with Stripe and the other financials. And so if you can't grow users anymore, you can't get it up anymore after COVID, then you've got a huge lack of PP, huge lack of pricing power. And there are some concerns that I have because of that with PayPal. I don't think its balance sheet is horrible. It's actually pretty decent. Their cash flow is phenomenal. But I just can't see the growth vision. And if you underwrite it from a growth point of view, you have problems. You have to underwrite it from a value point of view. But then, again, you're not getting buybacks, you're not getting dividends, and is it still being priced in as growth? To be determined. But it does feel like it's trading at the bottom, and it just wouldn't surprise me to see some kind of recovery, even if you just return to trend. My goodness, I mean, look at the opportunity. If you just returned to some semblance of a trend over here, you should be at least at $120, just returning to your prior trend. And $120 represents about a double on PayPal from here. And boy, it's so tempting to look at PayPal and say, well, would you rather invest in NVIDIA and go for a double at basically where it is now? Or do you go for PayPal and invest for a double? It's very difficult. So I find that to be a challenging stock for those reasons. Keep in mind, we do fundamental analysis every single day in the course member live streams. You could join those. We do many different companies every single day. The market is open. We're doing new fundamental analysis, and you're getting my full thoughts in detail and the archive of them, which is nice as well, because let's say you were to join today, you could look back at the last 6 months of fundamental analysis, go, oh, I wonder what Kevin's opinion is on SoFi, or what he sees at SoFi, what he sees at Palantir, what he sees at Dave & Buster's, what he sees at Carnival Cruise Lines, what are the risk factors, what are the potential upsides. So those are worth taking a peek at. Okay, so now let's jump into this fund manager survey before we get into PPI. And PPI is about 20 minutes away. So we'll say PayPal here. And we'll go fund manager survey. All right. So let's hit the fund manager survey. All right, here we go. There it is. Okay, good. Now we've got to cover what fund managers are allocating to, and Bank of America just released the fund manager survey for this month, and they give us some pretty good insight in terms of at least where registered investment advisors are allocating their clients' capital. And what I like to do is I like to be the contrarian. I like to look at this and go, okay, where are things crowded so I know not to go there? And so let's go through some of the individual sections that I've highlighted. The first, and this is not a surprise, we started making fun of this probably around 2 months ago. We started arguing, just wait. You're going to start seeing the recession calls for Q3 get delayed to Q4 and then Q1. And literally look at the fund manager survey here. Start of recession punted into Q3, Q1 2024. It looks like you have most people targeting, at least from the fund manager survey, about 33% of folks looking at a recession in Q4, and then about 25% in 2024, with 14% of fund managers seeing no recession in the next 12 months. Now, note here, you do have this optimism that seems to be slightly balanced between hard and soft landing when you look at the June and May survey. As far as where the bias is, though, it's definitely towards a soft landing. The hard landing narrative only resonates with about 27% of fund managers. And but most people are expecting a soft landing, which means not a stronger economy. That's important to consider, because if everybody's thinking of, oh, everything's going to be stronger, everything's going to be better, that becomes widely bullish. So soft landing shouldn't be considered stronger. It should just be considered not recession, but slower, right? So any kind of revisions to the upside where you actually do end up having a stronger economy would not yet be priced in, at least according to fund manager allocations. This is where you have that Chinese optimism flipping back to pessimism. This is something we talked about actually over here specifically. I called the Chinese reopening clickbait. And the reason I called the Chinese reopening clickbait is because, first of all, nobody knows clickbait better than I do. And so when I saw the setup for this Chinese stuff, I'm like, oh yeah, that's clickbait. There's no way with the lack of savings that the Chinese have relative to Americans coming out of the lockdowns, there's no way you're going to get this insane boom in China, and that'll end up driving inflation like people expected. Now, what you have now is basically optimism shifting to pessimism. But on top of that, yesterday you had an announcement of some rate cuts from the Bank of China. And so the People's Bank of China. So what you ended up seeing is you actually saw oil move up about 3% just on the day yesterday. Because China is now resorting to stimulus to try to basically help the Chinese get it up, and the pricing power is just not happening right now. You're also seeing some of that more luxury spend, that luxury discretionary spend, start showing cracks, and China can be one of the reasons for that. Here's another one. This was just 15% expect stronger economic growth. I find that quite interesting. This right here is remarkable because and Steve here asks, you don't think the government is going to stimulate in China? No, 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 they will. The government will stimulate, but remember that Chinese stimulus is different from American stimulus. Chinese stimulus is usually infrastructure spend or corporate stimulus. It is rarely consumer stimulus, and that is a very different, slower moving animal when you stimulate businesses and infrastructure compared to the consumer, which is a very quick and very spendy animal. Anywho, looking over here, just 15% expecting stronger economic growth. That's a really low number. Again, that in my opinion means markets still today, even after the stock market rally, are actually not pricing in the potential for a stronger growth set, which is remarkable. No, PayPal's not pricing in 6 PE. Yeah, I mean, if you go forward very, very far, maybe. But for the end of this year, PayPal's pricing in, just as a tangent, somewhere around a 12 to 13 PE ratio, which puts you at about a peg of 1. But again, if the growth of PayPal evaporates from 10 to 12% down to 5%, then you're actually starting to look, then you may as well buy Tesla at a 2 peg or a 2.4 peg. So keep that in mind when you're doing your growth valuations. Something obviously we regularly talk about, of course, in the programs on building your wealth, which is the perfect time for me to remind you about these 4 phases of price increases we have coming. This is going to be a reward to all the existing course members, as we've got large sets of new lectures coming out for stocks and psych. We're adding AI, real estate 0 to millionaire, adding AI, and then more AI lectures in the making more money in the productivity course. But we're going to have 4 phases of price increases. The first price increase will occur on June 16th. So check that out. I'll link it down below if you want to lock in the best pricing. Okay, back to the fund manager survey. This lack of really pricing in a strong economy is shocking to me. You have a net negative 62% expectation for a stronger economy being priced in. That's a sign of really, if we get growth this year and next year, people are vastly mispositioned. Still today, this is a survey that just came out, and despite this stock market rally, you still have a mispositioning. Only 2% of investors actually expect higher inflation. Inflation's basically over, but the question then is, okay, well, how long is it going to take to get inflation down? That's the real question now. So you've got this idea of the Fed flip-flop here. How many people actually think the Fed is done? Only about 32% of fund managers actually think the Fed is done. That's a flip from what we saw in May. But as of June, most people think the Fed is actually going to hike again in the future. So we'll find that interesting. First Fed rate cut expectations. Most rate cut expectations are sitting in Q1 2024. So no more rate cut expectations set for 2023 here or here. You can see those are relatively low, although there's still that chance for the end of the year. Okay, continuing here, we have investors wanting companies to increase capital expenditures at the highest level since September of 2022. Actually, not too terribly long ago, but you're still seeing more of this, likely because of artificial intelligence, a desire of fund managers to see companies invest in their companies rather than just save money and increase cash. Although improving their balance sheet is still very, very important, which is the blue line here. Cash level, you can see cash levels slowing a bit. We're still above the longer term average of where cash levels sit. The longer term average is the lower red line, and where we sit right now is the upper red line. So right here in between, if I shade this in, this shows you your excess cash position compared to history, according to fund manager allocations. So a little bit higher on cash allocation than expected. These are month-over-month changes in investor positioning. You could see investments, alternative investments, actually seeing a little bit of a rise. This could be like your gold, for example, and real estate, whereas a lower on cash for allocations. Jumping in over here, investors on bonds. Less interesting over here. In fact, I'm just going to move forward to over here because we have a different segment that talks about bonds. So this chart, fascinating compared to the last ones I just skipped here. This chart, fascinating. This shows you investor fund manager allocation to technology stocks versus energy stocks. And what you can see is technology stock allocation hit a peak in April of 2020 during COVID lockdown period and September of 2015. But if you draw a longer term average of where technology allocation has been between 2010 and 2020, ignoring the 2000s dot-com bubble disaster and the Great Recession, you can actually see we're allocated somewhat on the low side relative to where we have been in the last decade. And frankly, I would make the argument that inflation, or rather technology allocations today, are much more important. That's what I wrote here in the red. Much more important today than where they were in the last decade. So I think this low allocation to tech is a mistake. I started highly allocating to tech really in this November area over here. I even created a fund about November 30th that was highly allocated to chips and technology. At the time, everybody made fun of me for it, but I guess that's the way it works. So anyway, unfortunately, this one bothered me. They indicate that even though allocations to equity are low and growth expectations are low, the most crowded trade right now as of June 2023 is being long technology. So I thought, okay, does it make sense to allocate a little bit more again to the US dollar? And while I considered that, I realized you have a large opportunity cost of allocating to the dollar or treasuries, given the potential rise in equities. So that is a risk. Now, this was about the opposite that I thought. So it actually still is. So this right here shows you the worries that fund managers have for the market. And what you actually see is fund managers are most worried with about a 35% worry level of high inflation keeping central banks hawkish, followed by a global credit crunch at about 22%, geopolitics worsening at about 16%, some sort of black swan at 12-13%, and AI being a bubble at just 9%. I was actually slightly the opposite of this. Now, that's crazy to think. Oops, I knocked over one of my lights. Anyway, so I was the opposite of this. The reason I was the opposite of this is because I'm not terribly worried about this. I think that this is clickbait. So I'm going to break this down here. And this is what I think is incredible because you kind of want to see where you're different. So I found this to be, in my opinion, clickbait. I also think this is clickbait, which is the credit crunch. So in other words, this higher for longer nonsense and the continued hiking, I think these two are clickbait. I'm kind of neutral on Ukraine and Russia and the impacts on the market, as well as this systemic event. I'm actually more concerned about an AI bubble. And the reason I'm more concerned about an AI bubble is I think that people are really misallocating to software. I think that a lot of fund managers don't know anything about artificial intelligence and don't realize to some extent, and it depends on the type of application, to some extent how easy OpenAI and some of these language models have made it to create an AI startup or AI software. And an example I'd like to give you is Snowflake. And this hasn't played out yet, but consider this. C3 AI has been running on this idea that it's enterprise AI and they have a moat in enterprise AI and nobody's better than C3 AI at enterprise AI. So what does Snowflake do yesterday? They come out and announce enterprise AI. And it made me think, wow, that here's a direct risk and now a direct competitor to companies like potentially a Palantir or a Snowflake when you have, not Snowflake who announced it was Salesforce. Here's a direct competitor to Snowflake and Palantir and C3 AI. Salesforce, just boom, now we have enterprise AI. And the reason I say that is these companies have so many massive teams dedicated to creating the software suites that people are going to spend money on. That software competition for enterprise AI is about to explode. And it's actually going to give the government substantially more choices in determining what's best for them. That's a competitor to Gotham for Palantir. And it's also going to create competition for Foundry over at Palantir, which is their commercial enterprise segment. And my point of this is, I think fund managers are over allocating to software when it's really unclear who's going to win from the software AI-led revolution. And I'm not going to make bets on software. I've actually been reducing my exposure to software because I think it's too bubbly and frothy. I would rather allocate more to chips and chip manufacturing than software. I could end up being wrong about that, but I don't think I will be, because I don't think any of us know who is going to profit the most from AI. And remind yourselves of that. I'm not saying who's going to have the most customers or who has the best software. We're going to say who's going to profit the most from the software. That's a very different question. And that is a question that I remain unconvinced on, because the barriers to entry are like nearly zero. And it depends what you're doing with AI, right? That's where the barriers, because if you have to train a model and your IP is the way you've trained a model, then that's unique. But if your IP is, well, we'll make a software suite for you so you could use ChatGPT, you have zero moat, and quite frankly, you deserve virtually no profit. So it depends what the offering is, I suppose. Okay. Speaking of offering, have I shown you the price increase schedule, how we're raising prices in 4 phases for the courses on building your wealth? People ask me, Kevin, why are you raising prices? You're contributing to inflation. First of all, I'm not, because I'm not in this inflation report. Otherwise, I suppose I would be. But second of all, we keep adding more value. So if you adjust for the value we're adding, the courses are actually deflating. Even though the nominal prices are going up, the value you're getting is going up. It's so much more that that your nominal payment is actually less, or the real payment. There you go. That's the way to put it. The real payment is actually less. So risk barometer, you could see some more risk appetite coming in for fund managers. Look at this, folks. Look at that rotation away from staples and cash. We saw this coming a mile away. Finally, you're seeing that walk away from staples over here. Finally. Look at these fears. Now, if there's one chart that made me very, very excited, it was this. Look at it over history. Fears plummeting in the fund manager survey. Like, if you go to the bottom of this, look at some of these fears. EU sovereign debt funding crisis, the collapse of the EU, Chinese hard landing, geopolitical crises, US fiscal cliff. This is all back to 2013, 2011, 2012. EU is going to fall apart. Oh no, the Fed in 2018, the trade war, COVID. And if you actually look at where we sit on the fear level right now, if I take a big highlighter and draw it through the sort of fear level, we probably sit right about here, which is a little bit on the lower side of fear for high inflation and a credit crunch or a systemic credit risk or whatever, or hawkish central banks. We're actually not that fearful right now. But not only are we not that fearful with fund managers right now, look at these asset allocations here. These show you, now this is a little complicated to read, and I got to be quick because we got PPI coming out. So you ready for this? Let's summarize this quickly. See the blue line? The blue line are stocks going up. See the light blue section right here? Those are allocations. Fund manager allocations to equities are 32% underweight. That means there's still a ton of money sitting on the sidelines to go into stocks, which is insane. In fact, these fund managers are still overweight bonds. See that little blue, the little blue lines over here? They're still overweight bonds, and they're still overweight cash. A lot. This is insane how much fund managers are still underweight equities. Even though they've gone bullish long tech, they're still way underweight equities, which is mind-blowing to me. You're underweight real estate and equities. Well, we got to talk real estate as well. There's some real estate opportunities. And then global tech. Global, that's different because you get the emerging markets built in there. Still low, but a little bit more allocation to global tech compared to just American tech. So, bottom line, when you look at this fund manager survey, what do you get? Well, the fund manager survey is screaming at you that finally fund managers are realizing you have to go long US tech, but they're still way underweight US tech. There's still a lot of money sitting not just on the sidelines for cash, but in bonds. And I think as we start seeing real estate liquidations from institutions, which we're starting to see, you'll see more money flow into equities. And that's all very supportive to equities. Even though things feel somewhat bubbly right now, it's actually a lot of tailwind still behind us, which is insane. Now, we have to talk about the producer price index. That is a number that comes out in about 30 seconds. And these are the expectations that you should prepare for. We are looking for 0.1 to the negative for the month over month headline read, month over month. I guess that's not technically the headline. The year over year would be the headline, but it's not the core number. So headline is actually year over year 1.5%. A headline core would be your 2.9% year over year and 3.1 if you take out trade. And those month over month core numbers, you're looking for 0.2. Here we go. Drum roll please for the PPI numbers. The producer price inflation numbers come in at negative 0.3. Oh, big deflation number there for month over month. PPI final demand negative 0.3. Big miss to the downside. That's very, very good. That's deflationary. Oh, here we go. Look at PPI core. 0. PPI core comes in flat instead of the 0.2 expected. This is very bullish. This reiterates a Fed complete pause right here. This is a hard stop for the Fed, in my opinion. PPI final demand year over year was expected to be 1.5. You actually got 1.1%. Big miss to the downside. PPI less food and energy 2.8 instead of 2.9. PPI less food, energy, and trade year over year, you got 2.8 instead of 3.1. You did get a match on PPI less food and energy at 0.2. That was the expectation. But you take out food, energy, and trade, you're actually at 0. And you got a lower revision. PPI month over month, food, energy, and trade last month was 0.2%. You just got a lower revision from 0.2% to 0.1%. Holy smokes, the disinflation narrative is real. You could celebrate with me in, of course, the course member live streams, given that we have 4 phases of price increases coming up with the first price increase on June 16th. And you could email us at staff@meetkevin.com if you have questions. Staff@meetkevin.com. Course is linked down below. Okay, but let's get into the actual PPI report. And I want to see what Wall Street is saying here. But this is all a handsomely positive report. This is very, very good. All of these numbers good with lower revisions. I mean, this is the best you could ask for. PPI is a leading indicator, once again, for CPI. So keep that in mind. As a leading indicator for CPI, in my opinion, this screams pause to the Fed. This should immediately lower the odds of the markets pricing in a Fed rate hike in July. We'll see what happens. It should also lower our 5-year break-even rate, our market expectations of inflation. There's no way inflation expectations should unanchor with this kind of producer price inflation report. This is excellent news. Very good. So I'm pulling up the producer price report right now, and then we'll go through some of the details to see where some of this disinflationary pressure came from. But I have to say, this is excellent. You've got the Qs reacting slightly to the positive. I'm not sure if, less people pay attention to PPI, but you have a slight positive move on the Qs in pre-market. Although I expect that a lot of your institutional investors are going to really wait to move for the market to open. So waiting for the BLS website to load on PPI. It's loading a little bit slowly right now, but we'll get that document in just a moment. In the meantime, I'm looking for any kind of reaction from Wall Street. So far, relatively quiet on the street, and we have waiting again for this. Let's see, waiting. Okay, I do have more prior revisions. Let me go through some more of these prior revisions while we wait for more data. More prior revisions. Year over year number last month was 3.2% for PPI X food and energy, came in at a revised 3.1%, so another revision down. PPI X food, energy, and trade, another revision down. Last month came in at 3.4, revised down to 3.3. Basically, everything that was revised for last month was revised down. Not only that, you basically missed on every single number except for one, which was a match. Everything came in low. This is absolutely phenomenal. The fact that you're at 0% month over month on food, energy, and trade month over month, excluded from PPI, really, really good. I mean, nothing but positivity from this. This is very, very good. Let's look at the actual report now that we have it here. Producer price index for final demand declined 0.3% in May, seasonally adjusted. This is amazing, amazing, amazing. The decline can be traced to a decline in the final demand goods prices, which fell 1.6%. Goods falling 1.6%. That's great. Now, you did have services increase 0.2%, but that's probably one of the slowest increases in services that we've seen in a minute here. That's very good. No, we've been a little slower in the past here, looking at the chart over here. But anyway, 0.2%, that annualizes to 2.4%. That's not bad at all. That's very, very good. So let's see here. Let's get into some more detail here. Final demand goods moved down 1.6% in May, the largest decrease since falling 1.6% in July of 2022. Most of the May decline is attributable to a final demand in energy, which dropped 6.8%. And this is why we look at more of the core number, right? And when we look at the core sector, what else can we see here? Well, we could see 60% of this headline number was because of a decline in gas prices. But what else also fell? Chicken, eggs, jet fuel, fresh and dry vegetables, iron and steel scrap also fell. However, tobacco prices increased 1.7%. And there were some increases for electric power and for beverages and beverage materials. Coca-Cola, actually, we just went through as a team, we went through the Coca-Cola earnings report again, and they were complaining about commodities kind of sneaking up on them a little bit. So there you go, Steve. Look at Coca-Cola's commodities. Final demand services. So let's see here, services, prices for final demand services, less trade, transportation, and warehousing edged up only 0.1%. That is not a sign of sticky inflation. The fact that the only way you got to 0.2% of an increase was including transportation and warehousing. Warehousing is basically a negative anyway. Freight's in a recession, but some transportation services, as we saw in CPI, were hot. And if you remove these, the fact that you're only up 0.1% is insane. Although, look at this. PPI, looking at that, this is actually quite interesting. Transportation might have been hot on CPI, but not over here actually in PPI, because if you just look at transportation and warehousing, you're actually down 1.4%. So scratch that. That's actually a fantastic leading indicator for CPI. That is a great leading indicator right here on transportation coming down. So it must be trade. Trade is the only thing really propping you up over here for the 1%, and then some other aspects for the other 1%. Fine. Let's try to get some more categories to see, but this does not seem broad-based at all, which is good. I'm going to jump ahead. I want to get past the intermediate demand categories, and I'd like to get to some of the charts where we can get a little bit more detail on exactly where these numbers are coming in. No more revisions so far, which is good. Okay, we do have, here's a little bit of a Wall Street comment. That was a very dovish looking PPI print. Bonds are rallying a little bit, not as much as they sold off yesterday, though. So a slight move in yields, but not much. So the bond market not moving much, but definitely being labeled a, quote, very dovish PPI report on Wall Street right now. So looking at some of the more particular items here, what do we have? So let's see here. We're going to go to the seasonally adjusted month-over-month number on the right side. So our far right column is what we want to look at, as well as the relative importance level. So you could see final demand goods right here down 1.6%. That was a very big drop. Food, folks, down. Finished consumer, hold on a sec. That's final demand is up top at 0.3. Goods is the second one. Foods 1.3%. So goods down 1.6%. Foods down 1.3%. Consumer foods also down 1.3%. Government purchases of food actually up slightly. Not that part. No, sorry, down 0.3%. So these numbers are so tiny. Private capital equipment up 0.4%. Interesting. This is a sign of potentially more CapEx. Wouldn't surprise me to see this in, yeah, look at that. Manufacturing. Businesses are investing. That's so interesting about this quote unquote recession that we're in, is businesses are investing. They don't want to be left behind because I think they see massive economic growth ahead, and businesses are not skimping on buying the machinery they need to win over this next decade in this longer term Nike swoosh recovery. So they're continuing to invest, actually keeping pressure on machinery, private capital equipment, all of these over here, manufacturing, non-manufacturing, manufacturing growing the most. That is a big leading indicator here for optimism from businesses. You can't bet against this market right now, in my opinion. Final demand services, super nominal. Very good to see a nominal move here. Again, trade of private capital equipment, 0.9%. Yep, that's where you're getting the business investment. Where are you seeing losses? Final demand for transportation and warehousing. Oh, look at that. Minus 1.4%. That's great. Look at all these minuses. Minus, going all the way down over here. That's warehousing. It's warehousing of personal goods. It's warehousing of capital equipment. So in other words, the equipment doesn't have to be warehoused. Maybe it's just going, to some extent, it's basically going straight to the customer. So you don't have these warehousing shortages maybe anymore, the freight shortages that you used to have. This is all a sign of the economy becoming more stable. This is great. This is very good. Goods for export. What do we have for export? Negative 0.9%. Wow. Services for export, flat. What kind of services are we exporting? I guess that could be like legal consultancy or business consultancy. I suppose even the courses on building your wealth are kind of like consulting to some extent, right? Remember, folks, first phase of the price increase, June 16th, probably somewhere closer to $50 for each course. That's, for those of you signing up with Buy Now, Pay Later, that's like a free month basically, which is pretty wild. Yeah, and then of course that's just going to be the first of 4 price increases. We're expecting to be somewhere between $210 to $300 higher by the end of these 4 price increases, because that's when we're releasing the new lectures for Stocks and Psych, Real Estate Zero to Millionaire, and the Making More Money and Getting SH90 done. Okay, continuing here. And remember to email staff@meetkevin.com if you have questions. So personal consumption, negative 0.4% over here. Government purchases of defense equipment, also negative for government purchases. Wow. Where's the heat, baby? Where is the heat? There's none left. Really, where is the heat? I think it was just in manufacturing equipment. That was really the hottest sector I saw, which again is bullish for companies. You have a little bit of potential over here. What is this 0.5%? Well, let's look at this. Oh, that's just services less. Well, yeah, but that could also include some of these capital expenditures. That's just a category. Okay, fine. Looking at some more of the individual items. What else here? Yeah, the transportation of equipment or passengers, all falling. Great for CPI. Remember CPI. I want you to see that CPI chart again. Let me go to the CPI chart for a moment here. So CPI, where is it? It was this. Look at the CPI chart. And then transportation services right here, actually making up a big segment of that CPI over here. So, oopsies. Big plummet here in PPI, which is actually very good. That's very good. I don't want to sound too bullish over here, but this is a good report. Okay, let me see quickly what Wall Street is saying beyond this. PPI offers deflationary hope. Bonds received a small positive jolt from PPI, which came in under expectations. And then they reiterate the numbers, which I already went through. Clearly, the Fed will need to see a lot more evidence of pass-through into consumer prices to change its mindset. But this is a good start for anyone who leans towards seeing lower rather than higher yields moving forward. Agreed. You have to see those trends. You start seeing these transportation services and that disinflation come over to the Fed, over the CPI rather. It's going to be great. Very good report. Here's another summary of various different stages. I mean, look at all the negative. I want to just look at the positives for a moment. Negative, negative, and let's look at the positive. So what is this? Oh, these are stages. Construction inputs, construction inputs, construction inputs. People are building. People are betting on the next 10 years in America. That's for sure. There's no doubt about that. So the charts continue, but I think we have a pretty clear indication of PPI here. I'm pretty comfortable with what we see here with PPI. This is fantastic. I want to just quickly reiterate and then we'll take a listen to what CNBC is saying. But to have a 0.1% expectation and then get 0.3 is great. But more importantly, that core, that really core PPI, X food, energy, and trade, your volatile categories, coming in not only at 0% when the expectation was 0.2%, but also having a prior revision lower, phenomenal. Absolutely phenomenal. So we'll see how the Fed ends up reacting to this. I think that a lot of the market today is going to be somewhat concerned with just the Fed. So I don't know how much of a market mover we'll actually end up getting from PPI, but it will feed into what the Fed's decision making is. So let's listen to CNBC for a little bit now. Here we go.
Reaction. That's my answer, Steve. Today's PPI data and a look ahead to this afternoon's Fed's decision are optimistically cautious. How do we decide?
Cautiously optimistic is better.
Okay. We have talked about her 3 or 4 times already this morning. It's just her ears are burning. Economist and author Judy Shelton. Next, though, the door to the IPO market cracks open just a bit. We'll tell you about the restaurant chain going public and what other names could soon join what we're calling a parade. Not really a parade yet. There's like 3 people. Stay tuned. You're watching Squawk Box on CNBC.
Yeah, I just seem to be very good at catching their commercials. Oh, look, it's a Target commercial. Now, here's a company that's seen their stock fall a little bit, and they offer like a 3% dividend. We were doing some analysis on Target as a team, and Target's a toughie. It just competing with Amazon isn't easy. Let's put it that way. There's a reason they sell their goods that you can buy in the store cheaper. They sell them cheaper online than what they sell them for in store. So if you ever go buy a Target, always buy online. In fact, sometimes I'll go through the store and I'll compare. And almost always it's cheaper online. And then they don't let you go to the counter and be like, yo, price match yourself. They don't understand that. They can't comprehend that. I've tried. So has Lauren. We still try to price match. Okay. So what does this mean for the Federal Reserve? This PPI read? Nothing really. It just reiterates kind of what we've already known. It's not going to change the market's impression of what's important today. It's still going to be very important to focus on the forecast for the terminal rate, even though the terminal rate somewhat matters, as you've seen going forward, the Federal Reserve and their terminal rate doesn't seem to matter much to the market, given that the market is more interested in not getting Paul Volckered than it is caring about the terminal rate. So we'll see that evolve. And let's take a look and see what other news we have here. Fund manager survey was pretty good. We've got 5-year break even, kind of bobbing around a little bit, 2.14, 2.16. Then you look at, let's see if Wall Street has any more comments here. No more comments here. How about the futures on the rate monitor? Fed rate monitor for July. You only saw about a 3 or 4 percentage point slip on the rate monitor. So no big move there just yet after following the PPI report. Very well. No problemo. All right. And then we have, let's see here. Hawkish skip to leave room for final rate hike. Yeah, we'll see. Okay, yeah, here's a little bit more on the PPI. Just see if there any more commentary here. Goods prices slid the most in nearly a year. 60% was due to a decline in gas. Of course, when we strip that out, we still had declines. Several categories. Blah, blah, blah. Cost of processed goods for intermediate demand, which reflect prices earlier in the production pipeline, decreased 1.5%, the most this year. Wow. Separate data also points to further easing. Yep. Okay. What next? Let's listen to CNBC for a moment.
Than the fast casual category overall, according to data from Placer AI. 1% in May, year on year, compared to a decline of around 5% for that part of the sector overall. Comparable names in terms of concept are Sweetgreen and Chipotle both have strong performances for the year, up 23 and nearly 50% year to date, which could give some sense of investor interest in similar companies, rather. But Sweetgreen, remember, is still well off of its IPO levels. Other names may get in on the trend, including Panera, which announced it would replace its CEO in July in preparation for an eventual IPO. No timeline there yet. And on the smaller name side, Fat Brands' Twin Peaks and Gen Restaurant Group have filed paperwork to go public. Timelines remain to be seen, but Kava could give an indication on investor interest in the space moving ahead. Andrew, back over to you.
So, I mean, we were just discussing sort of where we are in the economy, what's going on in the markets. Why is the time now, if it is, for these names?
Well, analysts kind of say Kava could really set the tone here. I spoke to Blue Shirt Group, which advises companies on IPOs, did not work with Kava on this one, but that group said it could be a bellwether for restaurant IPOs, despite what may or may not happen with the economy in the back half of the year. We have to remember dining out is typically one of the last places that we see consumers pulling back. So the outlook for Kava looks good there. And it's kind of an attainable luxury, right? It could even benefit from a trade down if consumers are kind of shying away from casual dining, because this is a more affordable price point, but it's still higher end compared to like a McDonald's, for example, when you're choosing where to dine.
Kate, real quick, this is a money losing enterprise in terms of so there's a speculative element for investors here about when does this company break even and get to profitability. I don't know if there's a real sense of when that takes place. But the other question I was going to ask is, we keep comparing it to Chipotle. When Chipotle went public, was it a money losing enterprise?
I do not believe so. And obviously, as you said, Sweetgreen, too, is also still losing money, I think looking to turn a profit in 2024, Andrew. So a similar name there and another name in the same cohort. But Chipotle is doing much better, very different enterprise here, obviously, than a Kava. So it remains to be seen.
Okay. Well, we'll keep our eyes on it. I'm sure you'll be reporting on it all day. Kate, thank you. Appreciate it. Becky?
Thanks, Andrew. Up next, we'll get reaction to this hour's inflation data and what to watch when the Fed decides on rates this afternoon. Economist Judy Shelton will join us.
All right. So next, I want to talk a little bit about AMD. So AMD. Yesterday, AMD reported some excitement about a new chip. We got a new chip announcement. They suggest that maybe there'll be a little bit less of a reliance on GPUs, and it's obviously an attempted stab there at NVIDIA, because NVIDIA is just absolutely dominating. And the Amazon Cloud unit is apparently considering this new chip from AMD, but quote unquote, apparently they have not made a final decision. Honestly, I kind of think that's somewhat like nonsense, where it's sort of like AMD calls up Amazon, is like, hey, can y'all make a statement at least saying you're considering our new chip? Like, I think it's all kind of rigged in a game to some extent. But these new MI300 chips are supposed to be really exciting for AMD. Yet yesterday, AMD stock was down like 3% on the news of this new chip, as it quote unquote failed to impress investors. That's at least some of the arguments or some of the initial news reporting that has had. I like AMD. I think Lisa Su is a brilliant person, and I think they're a great company. But yeah, people are very biased towards, I would say, NVIDIA at the moment. Some of that could end up having to do with CUDA, right? NVIDIA has built a software stack that investors or coders use and are familiar with. And if you're going to create an AI startup, do you want to learn AMD's version? Do you want to learn something new? Do you want to speculate on something new, or just use what's tried and true and test it? So that way you could be, you could get to market faster. And so that gives NVIDIA massive edge. I still am unconvinced that it makes sense to be super excited about just like all in on NVIDIA. I do think having exposure to NVIDIA makes sense, but it'll be interesting to see what flow through we have, because here's what happens when you have a massive increase in sales from one quarter to the next quarter, which NVIDIA announced thanks to artificial intelligence, what people like to do is they like to take that growth rate and then they extrapolate it to every single quarter thereafter. And they're like, oh my gosh, NVIDIA is doubling their chip, sales. They're going to double it every single quarter forever, or every single year forever. And it obviously is just nonsense. It's not going to happen. At some point, the law of large numbers limits you. And really, I would project more of maybe instead of a 25% growth that NVIDIA was expecting, maybe you can go up to a 30, 35% growth. But are you going to be at 50, 60, 70% year over year over year? Maybe. But if investors are pricing in 100%, then you get problems. But anyway, Barron's indicated that they were one of the companies indicating that it was a failure. This was really a failure to impress. This new chip announcement from AMD. However, Lisa Su did give us some insight. She suggested that the potential total addressable market for servers could be about $150 billion in 2027 from around $30 billion this year. It is a massive increase in the amount of server chips that you'd be selling. It's about a 5x increase. Now, if you consider that from an NVIDIA point of view, and you look at their server chip segment, maybe you end up having about $7 billion of server chip revenue per quarter. That puts you at about $28 billion of chip revenue per year, right? Well, if they keep that growth, and let's say they stay flat for the next 5 years, that's already $140 billion. So if the market's assuming that NVIDIA is going to sell $28 billion of server chips a year, the market's basically assuming that the total addressable market is basically 90% of it is going to go to NVIDIA. Unless the total addressable market is underestimated by Lisa Su. And this shows you how frothy some of these numbers are looking right now. I mean, if Lisa Su's TAM is low, sure, maybe NVIDIA could do better. But then again, every time people talk TAM, I start getting this like cringiness feeling, because it just reminds me of the 2020 and 2021 FOMO days where everybody's like, well, the total addressable market, and they're trying to sell you on TAM. And I'm like, don't sell me on TAM. Sell me on your actual bottom line. What profits are you able to generate? And so that makes me somewhat concerned about the chip market. Now, again, I think this nonsense with Amazon and that it's somewhat clickbait. Really, I think the winner right now is Intel. I think Intel is the one that everybody's blind to, that nobody thinks Intel can keep up on the manufacturing side. But NVIDIA, you have to remember this. NVIDIA has considered partnerships with Intel once Intel gets the first in the world 3 nanometer chip manufacturing equipment. But even back in January, they announced a partnership together. So it's not just going forward for new products. You've had announcements and partnerships between Intel and NVIDIA previously already prepared. So these are companies that work together, mostly because the H100 server racks can use different CPUs. Remember how these server racks are set up? You could have about 10 of these H100 $35,000 GPU server chips from NVIDIA, and then you throw on like 1 or 2, maybe $5,000 or $10,000 CPUs on top to organize the server, essentially. I'm oversimplifying. And they partnered with Intel to get their 4th generation Xenon processors in some of these. But people also can just choose what they want to install, whether you want the Intel or you want the NVIDIA, the Intel or the AMD CPUs rather. And NVIDIA is also now considering getting into their own CPU production, which is interesting. I mean, you could just look at NVIDIA Grace and you could see CPU, and we've been of the anticipation that NVIDIA really wants to take control of that whole server rack. But what the big announcement really was what Jensen, CEO of NVIDIA, suggested about potentially using NVIDIA to manufacture. Using Intel to manufacture. I'm tripping on my words, and I apologize for that. But I think you understand what I'm saying, so it's okay. But anyway, here's a piece. I'll show it up on screen here. Here it is. This is back in March, which is really when you just started this AI run, and it's very relevant today. because we're not really expecting Intel's foundry services to really get going until probably somewhere around Q1 of 2024, to the extent that you can really open up to all of these other designers of chips. Intel obviously manufactures their own chips today, so they have experience in manufacturing advanced processors. But take a look at this. NVIDIA is in discussions with Intel to use Intel's foundry services, NVIDIA's CEO reported. Although any decision, it could be a lengthy one. This is true. Still don't today have a decision. They did call Intel an excellent partner and suggested that Intel is interested in us using their foundries, and we're interested in exploring it. We're open-minded to considering Intel and delighted by the efforts they're making. Now, this could also be just like the same kind of clickbait that Amazon is giving to AMD. Talking about, oh yeah, maybe we'll use Intel means nothing. But you do need some competition for TSMC, because right now NVIDIA does rely heavily on TSMC and even actually Samsung. But having an American manufacturer, which will probably be promoted by the Biden administration via the CHIPS Act, could be a potential play that a lot of folks are maybe overlooking right now. So that's why I'm watching Intel so much. And personally, I'd rather have a balanced allocation. Not personal advice for you, even though I'm a financial advisor. This isn't personalized financial advice for you. But I would have a consideration of maybe what you do is you set up some kind of balanced exposure where you have a balanced exposure to AMD, Intel, NVIDIA. So you're not too focused or too exposed to just one of them having a larger fluctuation. And instead you have somewhat of a basket. Although more recently, Intel, even though it's moved up, it's been compared to the likes of NVIDIA, has been somewhat of an anchor. If you sort of back test it, Intel looks like an anchor. But I wonder if you look at it going forward, if it still maintains being an anchor. We'll see. There are some risks to Intel. If, for example, NVIDIA doesn't end up using Intel, you've got some problems. So Barron's just a couple days ago suggests that Intel is really falling behind in the chip manufacturing space or the chip designing space, and that really their turnaround space for their 2.0 turnaround is just focused on how can we get to turning around manufacturing? How can we really ramp manufacturing? And so they suggest that for Intel to win, you really need a big customer. You need somebody like AMD or NVIDIA to go, hey, we're making so many chips and you guys are local and you guys say you can do it for a good price for us. How about we just use you? Now, TSMC is also manufacturing their own facilities in Phoenix, Arizona, for example, and Intel's getting into Ohio. So you have that local American competition, even from these foreign companies. And unfortunately, you're probably not going to see Qualcomm and Apple jump on over to Intel. So you're really kind of trying to hope that Intel is going to marry with NVIDIA or AMD. That's the big hope right now. But hope is usually not the best investing strategy. So I generally look at this and say, be careful about the value trap aspect for Intel. The downside might be limited and already priced in, and I don't think the upside is priced in already. In fact, I really don't think it's priced in. So that's one of the reasons I think maybe Intel makes sense for a balanced portfolio. But this whole AMD and NVIDIA chip thing, look, I think it's great. The more competition we have for chips, the better. The better it is for companies, the better it is for ultimately artificial intelligence. But to suggest that's it, every product everybody else comes out with is trash, and the only answer is NVIDIA, probably not true. But CUDA does give NVIDIA a very big moat. Now, there was another piece by the Wall Street Journal as well on Intel, and they really highlight this transition to becoming a contract manufacturer for some of these other companies, and how it's going to rely on basically getting these contracts, much like what Barron's reiterated. Now, the CEO thinks they can pull it off, and they are getting some of the most cutting edge equipment before anybody else from ASML, because remember, ASML is the supplier of this manufacturing equipment. And as we saw in the PPI report, remember the PPI report portion that came in hot? It was actually capital equipment and manufacturing. Here, I'll put that on screen right here. Remember, whoopsies. There we go. Okay, there we go. So Capital equipment, right there in the middle, that's where you're actually seeing those prices edging up. That's where you're actually seeing inflationary impetus is in manufacturing equipment. I think one of those is going to be this fight for chip manufacturing equipment. So we'll see what happens. But yeah, as PG says here, CUDA software ecosystem is currently hard to beat in the market. I agree with you. So we'll evaluate how things evolve for Intel. I'm optimistic, but we have to be realistic as well. And the same goes for being realistic about those growth expectations for NVIDIA. So remarkable market, but still a lot more promising, in my opinion, than what you potentially have for for software. Software scary right now. Anyway, let's listen to the CPI or Jim Cramer. I didn't hear anything.
The Schwab's revenue decline that was just announced is a little greater than people thought.
Yeah.
So that could be questionable segment.
I'm curious about your tweet as well this morning. What happens if the 10-year goes above the 2?
Well,
how about a gigantic wave of money?
I mean, look, I think that interest rates should, the longer term should be higher because we're discovering that there is a good soft landing. The shorter term could level off. I mean, I wouldn't be surprised if we saw a 20-year at 5. That wouldn't be so big deal. And then you'll go back to where the short rates will come down over time, not this year. And all these people who stayed out of the market because they looked at the inverted yield curve will be revealed as the frauds that they are. And we will put them on and congratulate them because they will have amnesia. But I have no amnesia. I don't have amnesia, David.
You don't?
No.
Okay. You say so.
I'm just saying that a lot of people just stayed out of the market because they saw the inverted yield curve, and those people are going to be wrong because that
You are getting more and more bullish by the minute.
no.
As
I'm
I sit here every
saying
day.
long-term bullish.
That's not good news.
I think that because of the press conference, anything can happen. Because the press conference is really, I mean, it's like a Nixon press conference. Are you running for president? No, are you? I mean, you have a Nixon press conference, which is, if anyone remembers those press conferences, it's like, why did you bomb Hanoi
Right.
on
Now you were
Christmas
referencing
Day?
Dan Rather.
Yeah.
Dan Rather.
Yeah.
I'm just saying that the press conferences are awful, and he has to stop them, or do one every 4 months. He'll do this.
Over communicating.
Yes. Over communicated. Right. And they have to, everyone gets a chance. It's a Hollywood Squares game. I mean, they should have Pat Sajak. He should run that
Moderate
press
the
conference.
Fed pressers.
Right? What do you think?
Sure. Why not?
Well, I mean,
Why not? He's
it's
going to
just
have time in his hands.
it's an amateur hour versus
Rather see
professionals.
Vanna White actually probably do it. Than
I think the
Pat Sajak.
Jeopardy is far more professional in the press conference.
Yes. It's a very professional show. Not as professional as it would have been had I been the host, but it is still professional.
Yeah, I knew we had to work around to that, didn't we? You had to go there.
Well, you went there. I just followed.
Well, David, you wanted to talk about advanced micro. And
I did. I want to talk about advanced micro. I want to talk about the chips. I want to talk
Yes.
about NVIDIA hitting
Yes.
$1 trillion. Sure.
The trillion
Because-
dollar
Yes, let's talk chips.
It's important.
$1 trillion. You know what, David? It actually is. I mean, here's the come in. The $1 trillion club is not easy to get into.
No, it's not.
And
Now,
it's
to
only
be
7
fair,
companies.
it did hit it intraday last week.
No, but you see, this is a monumental thing that people refuse to realize, which is that this company has come out of nowhere, which is a gaming card. We have left this out. The Chinese are not allowed to buy their chips.
No, their chips are advanced.
So the
gaming cards, as in chips
Right.
that powered games.
So the
not-
Chinese can do their Candy Crush all they want, but when it comes to nuclear weapons that are high powered and can be targeted, actually Jensen's not nuclear weapons. But I'm just saying that the H200, David.
When did they go from the H100 to the H200?
Well, you have to buy the Grace Hopper 200. That thing is so fast. Take a look at the flops that it has.
The flops?
Well, that's a unit of measurement.
Okay. I haven't taken a look at that. Do you want to elucidate?
I feel like this is like boomer talk. Oh my God.
Okay.
Well, see, you put them together, you bundle them, like what Larry Ellison did. By the way, Larry Ellison does have the fastest supercomputer. I mean, there's no doubt about it. Larry is close. Sofricats is close to Jensen Huang. And Jensen built that, and it's Oracle that is that conference call yesterday was real. Though Oracle gave up all of its gains
It is interesting. We actually have a downgrade today of some of the semi-cap equipment makers. Needham cuts AMAT and TLAC. They think that hyperscale budgets are still going to be constrained in the near term.
Well, I didn't understand that. I mean, they talk about the hype. I mean, I think that I had Applied Materials on, 3 weeks ago? And I have to tell you that the amount of business that they have just from Jensen, Gary Dickerson was saying he talked to Jensen. You know, he talks to Jensen regularly. Jensen wanted being the CEO of
NVIDIA, yes. Anybody listening to this show hopefully knows that at this point.
You know, someone told me to cool it with NVIDIA. I said, oh, you know what? I'd like to cool it with companies that go from 300 billion to $1 trillion, but it turns out our viewers like it.
There is a reason we talk about 6 or 7 stocks consistently. It's because their market cap adds up to more than, I don't know, what are they, 20% of the,
almost
25% of the S&P.
That was interesting. They basically said, hey, our viewers like it when we talk about the big stocks, so let's just talk about the big stocks. I mean, I see it to some extent, but then it's kind of like, are we misallocating to the not larger ones, right? Are we missing the story on the Intels or the Enphase because they're not on CNBC every day, right? Compared to NVIDIA. Market, by the way, is rotating slightly down into the open, probably because everybody is just going to panic over the Federal Reserve and what kind of potential rug pull we're going to get. But honestly, you should go into the Federal Reserve meeting with the expectation that Jerome Powell is looking at all these inflation numbers, and there should be no fear. If he does not need to cause unemployment, the Fed will not do so. If he does not need to raise rates more to quell inflation, like we got this morning in PPI or yesterday in CPI, then what's the fear? I don't know. But anyway, thank you to Theodore and Czar for becoming new members of the channel here. Appreciate you.
That's AI.
Right.
So that's that's not exactly solving the problem of nuclear waste. I mean, this is just, it's good. It's a good product.
Right. But I guess going into the meeting, there had been expectations somehow that it would blow people away. And during the course of the day, as you know, the CRM stock, this 2 days ago already came down.
Well, because when you listen to it, it was very nuts and bolts about, like, if you're ATT, believe me, you need that, because what happens is people call, they put you on hold, you don't know where it's going. The guy, no, now it's like direct. I think when Mike Sievert at T-Mobile starts to sit down with Mark Benya, even more people are going to switch to T-Mobile. And that's before they even give you the way of the Visual Pro.
I knew you were going to hit that.
Why? Because I may be right?
Well, you're right about a lot of things, but not all things.
Nobody's perfect.
No, nobody is.
Well, you're certainly right about AMD over the long term. Got at least 10 price target increases today. And then Lisa Su did talk about the size of the addressable market. Take a listen to this.
Yeah. Barry.
The AI has now kind of changed the way we perceive what we're doing in every industry, in every market, for all of our productivity and business applications. So yes, today we believe it's about a $30 billion-ish dollar market, and we think it's going to grow over the next 3 or 4 years more than 50% a year. So we see like $150 billion by the time we get to 2027 for just this incredible technology.
The thing was who she was aligned with there. She was aligned with Meta and Amazon Web Services. Meta, David, I don't know if
you had to explain what you mean by aligned.
Well, they were up there at the presentation.
Okay, and meaning what? That they're going to become big customers for AMD.
Yes, become big customers, and that's who you want as big customers. You don't just want Hewlett Packard. Now, I don't know if you noticed some of the things that Meta's been doing. I mean, they'll push you stories now that are exactly what you like on your watch. This is part of what they're doing. You get your stories on your watch.
Okay, well, I think that about covers it for the morning live. We're going to jump on over to the course member live in about 12-ish minutes, and we'll see you all there. If you haven't joined yet, remember we're going through 4 phases of changes, and then a massive new release for content is coming up, so stay tuned for that. That is actually on screen right now. There you go. So you can see that. So a massive new set of courses coming out. And then we have sort of the schedule of price increases coming up. Send an email over to staff@meetkevin.com if you've got questions. We'll make sure you get taken care of. But jumping over to the course member live stream after I make some coffee here. And we'll see you all soon. Thanks so much for being here. And we'll see you tomorrow. Actually, no, we'll see you at the Fed meeting. Yeah, go to the Fed meeting live. Set the little reminder on that. So that's actually 5 hours. See you there.